Ladies and gentlemen, a lot of what we do at the Lowy Institute involves the interactions of statesmen and stateswomen. And my favourite story along these lines concerns Franklin Roosevelt and Winston Churchill, about whom I'm publishing a book next year. And that's the only ad I'll make for the book. After the attack on Pearl Harbor by the Japanese in December 1941, Winston Churchill travelled to Washington to confer with Franklin Roosevelt. And these were less formal days. So instead of staying at Blair House or staying at a big hotel, Churchill and his entourage stayed at the White House, stayed in the residence upstairs at the White House. And one day, Franklin Roosevelt wanted to speak to Churchill. And the reason was Roosevelt had been thinking, what name should we give the Grand Alliance that was now fighting against the Axis? And FDR came up with the name, and the name was the United Nations. We forget this now, that before the United Nations referred to an organisation, it was the term the Allies used in the Second World War. So FDR had this brainwave, and he wanted to tell Churchill. So he wheeled himself in his wheelchair into Churchill's guest bedroom, and he was horrified to find Winston Churchill taking a bath in the middle of the room. He'd had a bath brought in, and there he was having a bath. And FDR was very embarrassed, and he started to wheel himself out and apologised. But Churchill would have none of it. Churchill called out for him to stop, and then Churchill stood up in the bath, naked, pink and dripping. "Come back, Franklin," said Churchill. "The Prime Minister of Great Britain has nothing to hide from the President of the United States." Let me say, I know the US Consul General is here tonight. Let me say, Niels, I am a supporter of a strong, close alliance with the United States, but any alliance can be too close. And in my view, that's too close. Ladies and gentlemen, my job tonight is to introduce my boss, the chairman of the Lowy Institute, Frank Lowy. But before I do that, perhaps as this is my first Lowy lecturer as executive director, perhaps you might allow me to say just a few words about the Lowy Institute. The Institute is the great project of my professional life. I've been involved with it since its establishment nearly a decade ago. I remained associated with the Lowy Institute even when I was at Brookings watching the rise of Barack Obama. So for me, being asked to lead the Institute is a great honour. I feel I've come full circle, and I'm delighted to be working with our outstanding board and my exceptional colleagues from the Institute who are scattered across different tables this evening. Frank Lowy launched the Institute because he believed that Australia needed to make its own future in the world, and because he wanted Australian voices to be heard around the world. And 9 years later, I believe that the argument for the Lowy Institute is more compelling than ever. After all the world events that the Institute has chronicled and analysed, the war in Afghanistan, the invasion of Iraq, the bombings in London, Madrid and Bali, the election of Obama, the rise of China, the fall of Gaddafi, the killing of Osama, the global financial crisis, who could credibly argue that Australia's security and prosperity does not depend intimately on the quality of our engagement with the world? Who could make that argument this week when the future leaders of both the United States, our great strategic ally, and China, our great trading partner, were resolved? And let me say that the world is becoming more important, not less important, to Australia. We at the Institute were honoured to host the Prime Minister at Bligh Street a fortnight ago for the launch of the Asian Century White Paper. As Australia's leading think tank, we at the Institute certainly feel the ripples of the Asian century. We know that it's upon us. Every report we issue, every event we host, is touched in some way by Australia's interactions with Asia, the region in which so many of our challenges and opportunities lie. The polarity of the world has shifted, and the world senses it. We certainly know it at Bligh Street. And yet, at the same time that the Institute needs to thicken its connections to Asia. At the same time, the government tells us all we have to double down on Asia. Australia has also been promoted to global rank. In the last 5 years, we've joined the two most important global forums, the G20 on the economic and financial side of the House, and now the UN Security Council on the political and security side. In my opinion, membership of the Security Council and the G20 does not distract us from Asia. It helps us in Asia. It means that we enter the Asian century with confidence and from a position of strength. But our new prominence will test us as a country. Having invested time and treasure to become members of these forums, it is not enough for us simply to take our seat and wave our flag. We will need to engage seriously and energetically on issues and on parts of the world that previously we might have let go through to the keeper, that previously we might have felt were beyond our core concerns. We will need, in other words, to move beyond the provincial and the parochial. Our leaders and our officials will need to engage at a higher level and a faster pace than they have ever done before. And most importantly, to justify our place at the big tables, we will need big ideas, because middle powers like Australia rise and fall on the calibre of their ideas. And ideas are where the Lowy Institute comes in. Ideas are powerful, and that's why we are so grateful to you all for investing in ideas, for following our work, reporting on our papers, attending our events, and supporting the Institute as individuals and stakeholders and corporate members. Two of our sponsors tonight, Qantas and the NAB, are corporate members of the Institute. I would also like to acknowledge other corporate members represented here this evening, including the Commonwealth Attorney General's Department, the AFP, EFIC, John Swire and Sons, PwC, Credit Suisse, Investec, Rio Tinto, which has recently made a new investment in our China research, which we will be announcing soon, and of course Westfield. Thank you very sincerely to those corporate members. Your support enables us to do our work. And a number of our other supporters, including the trust company, Etihad Airways, DFAT and others, have also joined us this evening. Thank you very much. Our biggest supporter, of course, and our biggest investor, our biggest supporter is Frank Lowy and the Lowy family. Ladies and gentlemen, please welcome to introduce the 2013 Lowy Lecturer, the Chairman of Westfield, the Chairman of Football Federation Australia, and most importantly for us, the Chairman of the Lowy Institute, Mr. Frank Lowy, AC.
Thank you, Michael. Ladies and gentlemen, I'm delighted to introduce our 2012 Lowy Lecture this evening. This is our 7th lecture since the series was launched by former Prime Minister John Howard in 2005. That was 7 years ago when the Lowy Institute moved into its headquarters at 31 Blythe Street. As we approach our 10th anniversary, I want to say how proud the Lowy family is of the Institute's contribution to the public debate in Australia and the wider world. We are here tonight because of the quality of our people and the quality of our supporters. Many are with us in this room tonight, and I want to join Michael in thanking them all. I want to thank in particular the Institute's board, which continues to provide valuable guidance to me and to the Executive Director. As always, we are ambitious to do more and bring even more friends to the Institute. We are delighted to appoint Michael Fullilove as Executive Director in August. Michael was present at the creation of the Lowy Institute in 2002, and he has been associated with us ever since, punctuated by a stint at the Brookings Institution in Washington. Ladies and gentlemen, the annual Lowy Lecture is our premier annual event where we invite prominent thinkers to reflect on Australia's role in the world. Previous lectures have come from the world of government, central banking, global media, global resources, the environment and science, and from the world of international security. This year, our speaker comes from the world of banking and finance. In 2008, the world faced a terrible shock in the form of the global financial crisis. While the Northern Hemisphere was affected, no country in the world can say that it was not touched by the crisis that applied even to Australia, which emerged strongly from the GFC. What happens in the world affects what happens in Australia. That's one of the reasons we established the Lowy Institute. Our speaker tonight, Cameron Clyne, is well qualified to talk about Australia's role in a globalized financial system and a globalized economy. Cameron became Group Chief Executive Officer and a Director of the National Australia Bank Board in January 2009. This evening, Cameron will look at the fallout from the GFC and what we need to do to better insulate the Australian economy from future international shocks. While Australia was able to weather that storm, Cameron knows that we cannot be complacent. Cameron, we look forward to hearing what you have to say. Ladies and gentlemen, please welcome Cameron Clyne to the podium.
Thank you. Thanks very much, Frank. It's a tremendous honour to be asked to address such a prestigious body as the Lowy Institute. And if that wasn't nerve-wracking enough, it was the comments while we're having a drink outside, people insisting I'd be interesting and insisting I'd be controversial. In the current environment, of course, if you're controversial and you generate offence, you're obliged to leave the room to signify that you're not accepting the offence that's been generated. Given this is quite a nerve-wracking speech for me, if you're leaving to go to the bathroom, can you just let me know you're going to the bathroom so I'm not actually losing my way feeling that I've generated unnecessary offence. But it is a tremendous honour to be asked to deliver this address and to be the first bank CEO to do so. The Lowy Institute does play a significant role in the public policy discussion of our nation. It was demonstrated most recently by its hosting of the launch of the federal government's white paper on Asia. My pleasure in addressing you this evening is made even more so by the support from the Lowy family, which NAB has proudly banked for more than 50 years. I'm proud to lead a bank that at a crucial point in 1960 said yes to Frank and to Westfield, and by the time of Westfield's 50th anniversary, a £500 investment at the time of its float would have translated into nearly $160 million for investors. Frank's entrepreneurial efforts have led to significant social and economic benefits, both in Australia and abroad. But Frank's story is a reminder that we ought to elevate the fact that Australia has benefited from the efforts of its entrepreneurs, just as we once said that we lived off the sheep's back. It's the effort of our entrepreneurs which has led to growth and jobs and higher tax receipts that can be applied to education, health and other essential national initiatives. Entrepreneurs time and again have looked beyond the ruck and have sensed opportunity worth pursuing relentlessly. Across the nation, there are hundreds of thousands of entrepreneurs who approach banks every year, seeking funding to pursue opportunities with the prospect of taking our nation forward. Indeed, one of the fastest and most reliable ways to stall an economy is to stop funding the very engines of its growth. Banks, regulators and governments all play their part in establishing the settings and therefore the availability of credit. All of these stakeholders need to work, not just at an overall design level, but at ground level, where individual businesses, entrepreneurs and investors operate to pursue opportunity. To put this in context, from 2000 to 2008, Australia's banking assets grew from 110% of GDP to 215%, which demonstrates the need to examine the structure of both our banking and financial system carefully in order to design solutions which will work practically at the ground level, ensuring credit gets where it is needed, when it is needed. While often we spend time focusing on the market implications, the reality is, as we've seen from recent overseas experience, the fallout of any crisis has greater social implications. It is for this reason that it would be wrong to assume this is only an issue for the finance industry. It's an issue for all of us. That is why it's a worthy topic of discussion to be explored at the Lowy Lecture, which has contributed so enormously to our national and international policy debate. As we move past the 4th anniversary of the Lehman's collapse, informally recognised as the peak and key moment of the financial crisis, it is clear that the global financial crisis has not been a short or easily resolved issue. While there have been periodic outbreaks of optimism, they've been outshone by the obvious long-term implications of debt in major economies. The reality of debt has weighed on financial markets as politicians have debated the merits of austerity and stimulus to deal with sovereign budgets. For Australians, the GFC has served as a reminder of just how closely integrated our own economy is with the rest of the world. This has had both positive and negative consequences. People rightly questioned why it was that US subprime losses led to interest rate movements beyond or independent of the RBA's interest rate movements. This created a negative sentiment around the industry and therefore a challenging environment for real reform. At the same time, from a positive perspective, while Europe and the US have been severely affected, Australians are beginning to see greater advantage of our adjacency to Asia and the economic benefits that will flow from that. One of the lesser referenced statistics from the GFC from an Australian viewpoint, yet a significant one in my view, is the considerable amount of business credit which was withdrawn from the system by foreign banks. Many European and US banks quickly retreated into their own shells, and over the past 4 years, foreign banks' participation has been patchy. The Australian banks, to varying degrees, picked up the slack. In a subsequent crisis, we should expect the foreign banks to retreat again. But will Australian banks be able to repeat their efforts? The situation, of course, could have been much worse were it not for the cooperation between government, regulators and banks at the most critical of times. I'll discuss that more shortly. But having averted the worst, there has been much reflection. Debate around the role of banks in an economy is always essential. It's only natural that when there is a severe financial crisis, that this debate will come into sharp focus. The extended nature of this financial crisis and the immediacy of the digital age has served to keep banks on both the front pages and the business pages, as well as generating significant online debate. Banks have made periodic and brief appearances on the front pages of newspapers in the past, but this has been a unique period where there has been an extended focus. The focus is as legitimate as the debate that has followed. The debate began with a very real question as to what role the banks played in fuelling the crisis, especially when taxpayers overseas were forced to directly inject equity to prop up failing institutions. This only intensified the public and political anger. As some commentators have noted, the severity of the GFC was because it was not one crisis, but 3 crises. First, there was a housing bubble in the US leading to asset devaluation. Secondly, there were highly leveraged bank balance sheets, meaning there was low capital cushion to absorb losses. And finally, there was a reliance by banks on short-term wholesale funding, which caused a liquidity crisis. Australia fared better than many countries across the OECD. We did not experience all the turmoil seen in foreign markets. We did not require the taxpayer injections of equity to underwrite our financial institutions. But we were not immune from the public debate, and nor should we be. In Australia, we have had no less than 5 banking inquiries since the GFC, reflecting a range of concerns. I do expect more inquiries in the future, but I hope they would focus more on future reform rather than other issues, which are adequately addressed by existing frameworks. These other issues, such as customer service, executive remuneration, fees and charges, levels of profitability and rates of interest, do warrant discussion. And banks have traditionally done a poor job of directly engaging with the public on these concerns. These are genuine public concerns and should be taken seriously. Over the past 3.5 years, we've led the banking industry in making changes to bring greater competition, transparency and fairness into the system, to build trust in our industry. We tried to follow talk with action, but that's a discussion for another time. The ongoing debate about transparency in the banking industry is important as it is serious. But this focus has clouded other key areas of reform that need to be debated. One of the great strengths of Australia's economy has been our preparedness to change, to ensure that we remain nimble and are able to respond to the challenges of a constantly evolving market. This is not new. Each economic crisis has resulted in reflection and reform. In 1820, the liquidity crisis prompted the establishment of currency standards and better basic management. The bank runs and collapses between 1850 and 1890 led to changes to bankruptcy law, reconstitution and capitalisation regimes and government intervention. In 1911, the Commonwealth Bank was established, which ended up as the central bank. In 1937, a Royal Commission instituted reforms following a review that found the loss of access to international capital markets and foreign debt fuelled the Depression. The liquidity squeeze of the early 70s was accentuated by a requirement to place 1/3 of overseas borrowings in a non-interest bearing account, highlighting the sensitivity of the economy to tight liquidity conditions. And in 1983, noticing the system had become too rigid, it needed deregulation. The Australian dollar was floated, and a year later it was followed by the issuing of 40 new foreign exchange licences. In 1985, 16 banking licences were awarded to foreign banks. Then we saw bank collapses and other financial institution problems, which ultimately led to the establishment of APRA and with it a stricter prudential oversight. What history has shown through these examples is that each crisis has led to improvements in the system. In the wake of the GFC, the regulatory framework has been adjusted through Basel III and other changes to reflect the requirement of a safer financial operating environment. But we are wasting this crisis by not advancing public understanding and therefore a climate conducive to subsequent reform. Public debate in Australia continues to centre on rate movements and profit levels. We're yet to meaningfully explain the way in which banks work, the risks they face, or how a healthy financial system that can withstand international pressures is vital in underpinning a healthy Australian economy. A national economy that will continue to create jobs and provide confidence and certainty for all Australians. A safer financial system will require structural changes, and we need to provide customers with a context of this and why this reform is important and necessary. We need reform to achieve three key goals. The first, we need to reduce our reliance on foreign wholesale funding. Secondly, we need to fund Australia's infrastructure. And thirdly, we need to fund Australia's future engagement in the Asian century. You could argue that with the worst of the crisis averted, that these are not pressing issues. And as we stand here today, they are not. Australian banks are stable and well funded, which is exactly why it's the right time to debate these issues. The implications of solving this funding problem will have a real impact on business and commerce. It will influence the availability and price of credit, business, housing and personal, and that impacts all Australians. If we don't provide the context and create an informed and engaged debate, then all changes to credit availability and pricing will be seen negatively rather than as a nation's insurance policy to promote future stability. It is estimated that approximately $700 billion of essential infrastructure is needed in Australia. The nature of these projects is clearly long-term, but our banking system and financial system is not set up optimally to support long-term financing. International banks have continued to withdraw capacity, and indeed European banks are estimated to have withdrawn $13 billion in just the last 12 months alone. As the European banks retreat, who will fill this void and meet new funding needs? This needs to be addressed if we're to prosper over the coming decades. While larger organisations of sound credit standing have a variety of funding options via the capital markets, small and medium businesses are much more limited. SMEs are the engine of economic growth and yet remain disproportionately reliant on commercial banks for credit required to fulfil their growth needs. So much of our confidence from job creation to housing prices to retail expenditure is determined by a strong SME sector, which is why it's in the national interest that credit remains accessible to SMEs. In any given year, Australian banks need to raise more than $100 billion offshore. When the crisis intensified in late 2008, the real impact on Australian banks was the increasing difficulty to secure funds in offshore markets. The wholesale funding issue was averted by the introduction of the federal government's guarantee on our commercial banks' borrowings. The provision of this so-called sovereign wrap for which the banks will pay the government approximately $5.5 billion, allowed credit to remain available in Australia. This was vital to our economy. One of the fastest ways to send an economy into recession is to restrict credit. If banks cannot source funding, they have to restrict lending. This is a simple equation. It is clear that any financial crisis, no matter what the trigger, automatically leads to a crisis in counterparty confidence. It therefore flows that when the next financial crisis emerges, we'll again remain at risk of a wholesale funding crisis, even if Australia remains immune from the root causes. Now, some would have you believe that this reliance on foreign funding places Australia in similar economies to Greece. Well, this is not the case, obviously. In contrast to Greece's ongoing problems, the Australian government guarantee was enacted in October 2008, and by May 2009, National Australia Bank secured unguaranteed offshore funding, the first of the Australian banks to do so. In a matter of months, the immediate funding crisis had passed, and the underlying quality of a AA bank was again at the forefront. The fact that Australian banks armed with a government guarantee were able to access funding should not be a case for complacency. What it demonstrates was that Australian banks were stable, the economy was performing, and once the immediate crisis had passed, we were an acceptable risk once again. The reason there should be no case for complacency for banks, for government or for regulators, is that we can never be sure when and how the next crisis will emerge. We can never predict how long funding markets will remain dysfunctional, or how effective traditional mitigants such as the sovereign wrap will be. What we should do is minimise our exposure to offshore wholesale funding markets. Now, while I have no knowledge or insight as to what might cause the next crisis, history shows there will be one sometime in the future. So let's make sure we're ready for it. Why do I know there'll be another crisis? Because there was one in 1637, 1797, 1819, 1837, 1857, 1884, 1901, 1907, 1929, 1937, 1974, 1987, 1987 and 2008. So it's a fair chance another one's coming. The global regulatory regime is certainly getting ready for it, and we must ensure that Australia is in the best possible shape, whatever the future can throw at us. However, the solution is long-term, complex and multifaceted. Australian banks have significantly reduced exposure in recent years, and we have sat out of the offshore markets for extended periods when spreads were wide and credit demand was low. But our banks still regularly feature in the top 10 of global issuance, which is disproportionate given we represent only 2% of global GDP. We are reluctant to further increase that position, but we do need to move towards more stable balance sheet settings required by our regulators. Now, some of the market may argue that currently we have no wholesale funding issues and that there are mechanisms in place to correct for any future contractions of global wholesale markets. There is merit in that argument, and today we do have ready access. But I believe there's also merit in taking a no-regrets approach. Generating greater funding flexibility is a sensible response. We should look at all our future funding needs and how we can protect the Australian economy and Australian jobs from any future international shock. Maybe it won't be a problem, and next time we face a crisis, the wholesale markets will remain open and accessible. Maybe next time a government guarantee will be enough for Australian banks to secure the required funding, and maybe next time Australia sails through it. But why wouldn't we ensure we have no regrets about the actions we take now? If we can take action now to ensure that Australia's future growth is less exposed to the vagaries of the international markets, then we should do it. We can look at profit levels, we can look at the relationship between banks and the RBA cash rate, we can look at the amount of available credit. But the first thing we must look at is our reliance on foreign wholesale funding. There is no one single solution to this issue. We need to examine all options in all areas, including changes to the taxation system, whilst recognising that tight fiscal settings are unlikely to provide much net tax relief. Some thought should be put into aligning the tax treatment of debt and savings. We should review how investment mandates may change given an ageing population, which will require a greater need for diversification and more fixed income options. As OECD data shows, Australian pension fund allocations to fixed income are only 9% compared to an average of 53%. Expansion of the domestic corporate bond market is currently receiving attention, and that should continue. The advantages of a deeper corporate bond market include a lower risk funding model for the banking system with less reliance on offshore funding, resulting in a system that will be less susceptible to offshore market closures and improve stability of economic growth. An important ingredient to assist the growth in corporate bond issuance is to take a more considered approach to the current levels of required prospectus disclosure requirements. Transparency is vital for retail customers to make informed decisions, but a streamlined approach is something that should be closely considered. And we should further develop the securitisation market and look at the treatment and role of prime residential lending on balance sheets, which remains an area of opportunity, particularly given models that operate offshore. I acknowledge that Australia's reliance on overseas funding is a very complicated issue, as it has been for over 200 years. There is no simple one-step solution that we can pull off the menu of change. It's more a degustation, bringing all of the required changes across the system that will leave Australia better placed to deal with future crises. If we are to have a son of Wallace inquiry, or grandson of Campbell, or great-grandson of Martin, then let's assure that it's far more targeted and focused than the 5 inquiries we've had since 2008. Let's ensure that it leaves us well positioned, not only in dealing with our domestic funding issues, but in supporting our growth into and with Asia. As the federal government's recent white paper set out, we have an ability to develop our markets and our relationship with Asia. To not only extend our relationship, but to deepen it. Never before have we had the opportunities that the Asian century provides our economy. Never before has the centre of the global financial world been so close to our shores, and we must be ready to engage. The Australian financial markets are in a great position on the world stage. Australia has strong, safe banks, a well-regulated financial services sector, large pools of funds in the private wealth sector through our superannuation savings, and the Australian government is in a strong fiscal position. We have continuing regional demand for our exports from Asia. But it's much more than banking and commodities. It's education, health, professional and financial services, manufacturing, retail, tourism, to name a few. The opportunities are vast. As the white paper on Asia pointed out, Australia's share of global output has doubled in the past, Asia's share of global output has doubled in the past 40 years, and real GDP is projected to increase from US $27 trillion in 2011 to US $67 trillion in 2030, larger than the Americas and Europe combined. And in the last week, the Chinese authorities have announced their goal to double GDP by 2020. The reality is that the investment needs in Asia are huge. And with European and US banks constrained, there will be a growing expectation that Australian banks will match the political intent of greater engagement with financial support. The issue around financing the domestic economy is only part of the challenge. As we continue to build our engagement with Asia, we need to leverage our banking system strength as a source of advantage in Asia. But we must remember this is a two-way street. Whilst direct foreign investment and foreign funding are different asset classes, they can be influenced by similar factors. Any signs of a closed Australian mentality or economic xenophobia is completely unhelpful and not in keeping with our aim to be an engaged partner in the Asian century, not just a beneficiary. So our economy needs to be match fit. It needs to be ready, and above all, it must be vigilant to the dangers of complacency. We must be better prepared for the future growth here and in Asia. Our economy must continue to evolve and become more nimble. If we are to have another inquiry into the finance sector, we must make it count. We must focus on the fundamental issue of how we fund the future of Australia and ensure we are ready, willing and able to be an engaged partner in the Asian century. It will help to build confidence in our economy and our ability to withstand future international turmoil. The real impact of the GFC in Australia has been the impact the crisis has had on confidence levels at all levels of the economy. As confidence builds, we must ensure we have the right settings and frameworks to fund our entrepreneurs and to fund growth. One certainty in life is that there will be another financial crisis, whether it be in the next 5 years, the next decade or beyond. So we have to have the opportunity, we have to take the opportunity now to better prepare Australia to meet the credit demands of Australian businesses and households in the future and our engagement with Asia. The way our economy has emerged from the GFC has given us the right to be able to discuss future options for our economy, particularly at a time when many countries are still waist deep in working through the impact of the GFC. But with that right comes responsibility, and that responsibility is to future generations of Australians to ensure our economy is strong, resilient and able to create the right jobs given the opportunities that are on our doorstep. Let's do the hard work today and not waste this crisis. That way, we'll hand out onto future generations an Australian economy which is considerably stronger than one we inherited. Thank you.
Thank you very much, Cameron. And let me compliment you on that lecture. You mentioned the degustation, the selection of small, perfectly formed courses that satisfy at the end, and I think I'd describe your lecture in those terms, so thank you. Cameron has agreed to take questions for about 15 or 20 minutes, which I will moderate, and I'll do my best in the glare to see people who raise their hands to ask questions. While I'm waiting for the forest of hands to raise, perhaps I can kick off, and I might start where you ended on the Asian century. And can I ask you a couple of questions, Cameron? First of all, so far, the main commercial engagement Australia has had with Asia has been on the trade side in terms of imports and exports. Why is there not more Australian investment in Asia, which can lead to, in some cases, more deep and permanent ties? And secondly, you warned against, and I took careful note of this, a closed Australian mentality or economic xenophobia. And I don't want to put you on the spot, but can I draw you out a little on that comment and ask you to explain what kind of comments you had in mind?
Well, I'll start with the second, if you like, because I think what is clearly apparent is that any comment made by anyone who is purported to have a role of influence, be it a business person, a politician, regulator, others, is carried around the world quite quickly. And I observed from personal experience that when comments have been made in Australia that are somewhat perceived as hostile to foreign investment or engagement with Asia, it is received negatively. And it's received in a concept that Australia would like to be a beneficiary of Asia, but not necessarily pull their weight and demonstrate participation in it. So that's, I think, what I was particularly drawing out there. With regard to why, you know, we're not necessarily seeing the level of investment, it is early days, and in many cases we're dealing with, you know, some markets in that region that are not as yet open to how we would get involved in financing those opportunities. But the opportunities are vast, and there is no way that the domestic institutions in Asia can deal with them. And I think there's a wonderful opportunity to marry our intellectual capability with the funding need. And I'll give one example, which I didn't give in the address, but I was recently in India, and some agricultural officials there, and we have the privilege of being the largest agricultural bank in this country, were lamenting the fact that the food spoilage rate from farm gate to plate is over 30%. Which is an enormous challenge when you're trying to feed a population. Now in Australia, of course, it's sub 2% because we have a highly industrialised agricultural supply chain. And what they were saying is there's a wonderful opportunity for Australian companies with their intellectual property to come and help industrialise the supply chain, to build grain elevators, rail storage, you know, those sort of things, but also an opportunity to participate in the investment, because that would streamline the process. So now the rules aren't quite clear yet as to how you do that, but it was a great example of actually marrying our intellectual property with the ability to fund, you know, a really attractive opportunity in what's a clearly attractive growing part of the world.
That's great, a business opportunity for anyone in the audience. Can I ask Alan Kohler, please? Alan, if you could just wait for the microphone, and I'll say this to every questioner, a microphone will come. Thank you.
Cameron, perhaps I could invite you to be a bit more specific about how we're going to increase wholesale funding, decrease our reliance on, or the bank's reliance on wholesale funding. You talked a bit about the need to rely on tax and on debt and savings and so on. And obviously the banks are all increasing their domestic deposits to the extent that they can. But what specifically can and should the government do?
Well, I think there's going to always have to be wholesale funding, because there is insufficient domestic savings in Australia to close the gap. And even at the time of high national savings, the average bank balance sheet is probably only about 65% covered by domestic savings. So there'll always be a need for institutional funding to close the gap. I think what I'm arguing for is that we source more of that domestically. The money is here, it's in the wrong places. So it's in other asset classes because they're more tax attractive or they're easy to invest in. So we have an emerging sector. We have $1.3 trillion in superannuation assets, the third largest capital market in the world. So I think what we're arguing is to say that we've tended to look at some of these solutions too hard, either increasing the tax effectiveness of savings, improving the domestic bond market, those sort of things, looking at investment mandates, because wholesale markets have been readily open overseas. So I think putting all of those issues on the table and saying, well, we have the money in Australia to be more self-reliant, we need to move it into domestic wholesale rather than offshore wholesale. What should the government do? Well, there's a lot of talk around an inquiry. I'd be saying zero in on that. There are adequate frameworks in place now to deal with many of the other issues, which are of legitimate concern. As I said, banks have not engaged on these issues. We have excellent regulators in ASIC and the ACCC and APRA to deal with those other matters of concern. If we're going to have an inquiry, let's zero in on setting up an insulated funding base, because what you don't want to have a situation is that we miss the opportunity to build our $700 billion of infrastructure here and fund our participation in Asia, because we're locked out of markets because of our reliance on the overseas market. I think that's the central point I'm trying to make.
Can I call on a good friend of the Institute, Malcolm Turnbull?
Thank you, Michael. Cameron, you talked about the engagement with Asia and Australian banks doing more in Asia. Historically, institutional investors have not rewarded Australian banks for offshore activity, and they've been prepared to invest in Standard Chartered as an emerging market banker, but they've not favoured Australian banks being involved in emerging markets. And of course, it was in large measure institutional shareholder attitudes to ANZ's holding in Grindlays that caused ANZ to sell Grindlays years ago. Now, what do you think is going to, how do you change institutional shareholders' attitudes so that your expansion into wider markets, particularly Asian markets, will be welcomed and be accretive for your shareholders?
Yep. I think, Malcolm, your point's quite right. Traditionally, those investments have not been supported. I think what I'm observing now is that there is such an overwhelming desire and activity from our business customers that the logical extension is that if you're not partnering with those business customers into the region, then in fact you're not growing with them. So I think the change was that in previous forays into those markets, our engagement was much more sporadic, the opportunities were not as well defined. And I think what we're seeing now is that, we're Australia's largest business bank, and we estimate reasonably accurately that 60% of our business customers are what we define as Asia active. So I think the proposition is that with that many customers engaging, and also the inbound flow of inquiry says that it just becomes almost a natural extension that you would consider no differently putting 20 bankers into Shanghai than putting 20 bankers into Perth or Brisbane, because it is just becoming such an integrated part of our economy, which was not a feature perhaps in those early and more speculative investments.
The next question is from Robert Milliken from The Economist.
Thank you. Cameron, I'd just like to pick up on your point about confidence in the economy. The world, gave Australia a pretty good credit for surviving the last shock with a well-regulated financial system, among other things. And the first thing that many foreign visitors to Australia comment on is the pessimism among Australians towards their own economy. Australians are not so generous. And I'd just like to seek your perspective as a senior banker on this apparent disconnect with the way the world sees Australia and the way Australians see ourselves.
Look, that's an excellent question, and it is the current dilemma of the Australian economy. I don't have an easy answer. And if you talk to Australian businesses, as certainly we do every day, the interesting thing is each of them will have a different reason for lacking confidence. So it's not as though one trigger. Some will point to the political environment here, the fiscal cliff, the sovereign debt issues, the high Australian dollar, a range of factors that seem to contribute to it. And what I've observed is that you can very much bring home some frightening statistics about overseas markets. I can definitely frighten people with the UK if they need to be about the performance of that market. But you can talk to them about Spanish youth unemployment at 50%. But they will say to you, yes, but Australian unemployment used to be 4.8%, now it's 5.4%. And I don't live in Barcelona, so I'm not particularly interested in that statistic. So their frame of reference is Australia, and to them it feels worse than it was. So, you know, now the interesting thing, of course, is we see what we would term opportunistic confidence, in the sense that outbound tourism is at a 30-year high. So people are saying, I'll take advantage of the dollar to engage with the world, but they don't have that frame of reference that says, well, you know, we didn't have government bailouts, we don't have that youth unemployment, we don't have massive defined benefit pension liabilities, you know, all of those sort of things just don't have a frame of reference. And then they'll point to the menu of things they're unhappy about, and it leads to weak confidence. And at the moment we have that. Now, at the moment it's more of a psychological than an economic condition, because it really hasn't translated, although credit growth is low and other things, it hasn't translated into a real downturn in the economy. But the danger, of course, is the longer it persists, the reality becomes. And you fear as each year goes on with this sort of malaise that it's much more likely to become a reality.
Cameron, can I ask you about the G20? I think the G20 was perceived as having had a good GFC, if you like, but there's also a sense that some of the momentum around the G20 has come off since 2009. From where you sit, how important is the G20? How valuable is it that Australia is a member of the G20? And as we look ahead to Brisbane hosting the G20 leaders meeting in a couple of years, what do you think can be done to strengthen the role of the G20 in the world economy?
Well, I think the G20 was clearly a very positive force for quickly bringing about stability in the system. I think there's an ongoing debate as to the degree, I guess, from a banking regulation point of view, the degree to which we should be signing up to some of the mandates that have been developed, not so much through the G20, coming out of the G20, but more driven through things like the Financial Stability Board. And of course, I think we have no option but to sign up to these if we are seeking offshore money, because you're saying we have to play on that level playing field. So whilst we have the current economic structure, I think it's in our interest to be well engaged in that. And although it is always a case to complain about regulation, I think if you're in the foreign markets, you need to demonstrate you're a good global citizen to provide comfort and transparency to those people who are investing in you. So I think it's a powerful forum for us to engage, and I think given it established its credibility through the way it dealt through the last crisis, and it's one of those situations where if you're in the middle of it, you have which I was having just taken over, you have a much more acute perspective of how real it was. That having a forum like the G20 and having had its experience previously, the way it could reactivate to deal with any future crisis, I think is quite powerful. So I think having a seat at the table puts Australia in a very unique and powerful position.
I just have time for one or two more questions. One question from the lady on table 3, I think.
Hello, Cameron. My name's Dr. Katrina Wallace. I'm not a corporate. I own a number of small to medium enterprises. And it's been fair to say that it's not been easy for us in the SME market to get significant funding to grow our businesses. How is the landscape looking over the next couple of years for those of us in the SME sector in getting funding and credit to grow?
Yeah, I think it has been patchy over those years for a whole variety of reasons. I think in partly it's been patchy because there have been periods when funding has been tight. It's also, in many respects, there's been a tightening of risk settings. I mean, we had a GFC because what you would term to be traditional underwriting standards were abandoned. And so in many respects, we've gone back to what I would term pre-1994 risk settings, and that's challenging for organisations. But I think that the challenge we're placing, I think that we have to lead as the largest business bank is we've got to make sure SMEs are funded. There was a lot of capacity withdrawn through the crisis. Now, we're very proud that we actually were a net lender during that period, but we have to do more because it is the engine of growth and it's a factor of confidence. And if SMEs aren't securing the credit they need to grow, then it does have an impact. So I think the challenge is to get some of the stability into our system so that we do have the security and the confidence to lend to SMEs.
Final question from Professor Bob O'Neill, a Lowy Institute board member.
Michael, thank you very much. I'm very interested in the fact that we sit alongside economies of very different characteristics: Japan, Republic of Korea, China, Singapore, Indonesia, and so on. And that suggests to me, as an international security specialist, that there is some strength in diversity there. Could you tell us a little bit about interbank cooperation around this network and how Australia is placed as a result of good relations with these powerful but different economies to weather the storms that will undoubtedly come along?
I think that cooperation really comes at two levels. There's certainly obviously the central bank coordination, which has remained very strong and was obviously strengthened through one of that long list of crises, as I mentioned, was of course 1997 and the Asian financial crisis. And I think those relationships have continued and continue to be quite strong. But through that crisis as well, the banks formed strong relationships. And we certainly look at Asia not as a homogeneous block, but different opportunities. We see different opportunities in Indonesia and the way our customers engage with that market versus India versus Korea, Japan and others. So those links have been well established, and like many things, crises drive them. And the 1997 financial crisis was certainly one that drove tremendous cooperation between a whole range of banks across the region to deal with it, because there is also, like any crisis as there was here, there is an initial shock where there is counterparty issues, but you quickly realise we're all in this together. And we can play a game where I'll beat you in this syndicate, but the next one you're on top, so you quickly realise you need to work through it. And that was a feature of 97, and I think that strengthened our relationships. And those relationships have been continued because the economic growth has continued. So I think we're in a unique place to deal with certainly our banks across the region, but we do tend to look at it, we don't look at it homogeneous, we look at each market in isolation because they are quite unique in their own right.
Thank you, Cameron. And can I call on Michael Thorley, AO, to move a vote of thanks to Cameron Clyne on behalf of the board and the Capital Group. Thank you.
I would just like to start by thanking my fellow sponsors, in particular the admirable Alan Joyce and Qantas and Joseph Healy and National Australia's Bank Business Banking Group. And the third sponsor, my own company, is probably the least well known compared with these other two great Australian icons. But we have recently opened an office in Sydney, and which is looking at or supporting our role as asset managers for Australian corporations and government agencies. But we have also been, for nearly 40 years now, one of Australia's largest foreign portfolio investors, and played actually quite an important role in providing the sort of liquidity that we've just heard about. On behalf of our chairman, Mr. Frank Lowy, and my fellow directors, I'd very much like to thank Cameron for an extremely thoughtful speech, and one which has given, I think, quite an agenda for a number of institutions in Australia and for think tanks and the media. And he's reminded us that it was not luck that ensured that Australia's banking system emerged so well from the global financial crisis. It really proved its strength, both the quality of the individual banks and the quality of our regulatory structure. He's reminded us how crucial a strong banking system is to the health of our economy, to our businesses, and to achieving our international objectives. To me, as a member of the Lowy Institute board, he's underlined how, if Australia wishes to achieve its international political and strategic objectives, it needs to have great financial strength. He's reminded us that we need to avoid complacency because inevitably, however well we came out of this crisis, there's going to be another one. And he's reminded us how important it is that our system provides the the capacity to fund the development of our human and physical infrastructure. Thank you very much, Cameron. I think it was a fantastic speech. It's given us a very clear agenda, raised some very important issues, and I'd like to ask my fellow board members and all of you present here to join me in expressing our appreciation.